Hey everybody, this is Greg Gossett from Gossett Trading and Mentoring. How you doing? Today is Saturday, September 14th, 2024. I appreciate you coming by today. I appreciate coming and investing the time. I hope it's going to be helpful for you. Wow, what a week. Well, the market as normal, straight down or straight up, nothing in between. Like I said, appreciate you being here. I hope this is going to be a good podcast. I have some good information. The format for today is, first of all, we're going to run the U.S. legal disclaimer. Secondly, we're going to come back. We're going to take a look at all the current positions that I have or traded last week, both the opened and the closed one. We're going to talk about when I entered the trade, why I entered the trade, what the thinking was, what the setup was, what were the combinations and confluences of indicators and signals lining up at the time I took the trade and why I took it. We're going to talk about where I placed my stops, why I placed my stops there, and then how I am going to manage the trade going forward, whether it goes my way or goes against me. We're going to talk about how I take partial profits on the way up, important levels above if I'm long, and just basically my process and how I'm going to manage it. So, hopefully seeing how I look at setups, how I position size, how I place the stops, and then how I manage the trade going forward. I hope it's going to be helpful for you. If it is, I would really appreciate if you could hit the thumbs up button. It really does help the channel out. After that, we are going to talk a little bit about trader psychology. I always like to talk about trader psychology, as you know, because it is the most important skill in trading. The ability to create a plan and then follow that plan. There's many plans that you can use. There's not just the way I trade. There are many different good trading plans. But the common denominator of all of those plans will be that one, you need to position size correctly based upon your account value and the current volatility of the market. You want to be patient, wait for multiple signals, confluence combination of signals to happen at the same time. You need to have a good risk to reward ratio so that if you are wrong, you can be wrong small, but if you're right, you have the potential for a large outsized win. That's very important. And then know how to get out. As I just mentioned, I like to partially phase out of a position as it's going my way. I like to play offense and defense on a trade. We'll get into that a little bit. Later. But position sizing, confluence of signals, good risk to reward ratio, and then more importantly, not getting in and messing with your trade process once it's in place. I deal with a lot of students. I deal and speak with a lot of different traders around the world. And this is one of the most common things that I see happening is that they have a good process, they have a good plan, they start off with a good plan, but then for whatever reason they don't follow it. Well, I heard this on the news, or I'm thinking this. Yeah, I think the same thing. But the important thing is that if you have a good, solid trading plan, process in place, follow the process. And again, this all comes back to trading psychology. And so hopefully it will be helpful for you. It's always helpful for me to teach, and so hopefully it will be helpful for you. After that, I did go down through my watch list last night, my master watch list, and I have identified some potential setups, some potential trades next week that I am looking for. They are not where they need to be yet. If they were, I probably would have already taken the trade. But one of the biggest advantages that you have as a retail trader is the ability to be patient and wait for the trade to get to the location that you want. You're under no pressure to have to get into that trade. Large financial institutions, sometimes they just have to get into a trade. You're not. It's like Warren Buffett said, there's no three strikes rule in the market. In baseball, there's a three strikes rule. You just can't sit there and wait for the perfect pitch to come across the plate because you get struck out. But in the market, you can sit and wait until you get the most perfect pitch and then take a swing at it. Even if you swing at it, doesn't mean you're going to hit it, but let the trade come to you. When I look at a chart, the price could be 4.5% above where I want to enter. But I'll just say, hey, if it gets here, that's my spot. If it doesn't get there, I don't mess with it. I just move on to another market. Eventually, something will get to my location. So I have identified some potential long trades and short trades next week that I'm looking to enter. They're not there yet. And then I've also identified some on the weekly. As you know, I like to trade multiple time frames. I like to trade multiple markets and multiple strategies as well. But I have identified some on the daily and the weekly that I'm looking for next week. And if they get there, great, I'll consider taking trades. So anyway, I hope this is all going to be helpful. Oh, and by the way, I am going to speak a little bit about the markets in general as well next week, because we have the Fed meeting. Of course, the market is widely expecting that the Fed is going to cut rates. The only question at this point is whether it's going to be 25 basis points or 50 basis points, and that will have an effect on the market as well. In my opinion, is that they're going to cut 25 basis points, and I think the majority of the market's expecting that. If they cut 50 basis points, I have a feeling the market may not react so well to that. But I'm going to go back in history. I'm going to show you what the market generally does when we have these rate cuts, and I bet you it will surprise you. All right, so we'll do that as well. So let's get this U.S. legal disclaimer out of the way, and then we'll get rolling.
This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Please carefully read and/or listen to the U.S. government required disclaimer before watching this video or live stream broadcast. The video link and disclaimer text are located in the description section of this video or live broadcast, here and here. Thank you so much.
Okay, let's get going. All right, let's start off with QQQs. Okay, we'll go through my current open positions on the daily time frame. Okay. This has been a really good trade. I got into this trade all the way back here on the 5th of August. So I've been in it for some time. But I just talked about being patient, waiting for important levels to come into play and confluences of indicators. Well, take a look here. I got long the Qs on the 5th of August here at 435.31. Okay, why? What were my signals? I had 3 different signals happen on the same day. So there's my confluence. First of all, notice the black line. This is the 200-day moving average. This is a major moving average that major large investors, large financial institutions will key off of. In above the 200, out below. So this is a deep dip buy strategy. Okay, this is one of the strategies that I use and one of the strategies that I teach, and it's a great one. It's not very difficult. It's just pretty simple and waiting for those deep dip buys to occur. So during the day, you can see we opened below the 200-day moving average, the black line, but we closed back above. This is called an intraday rejection of the 200-day moving average. And just that by itself is a legitimate signal. However, I like to have multiple signals. They improve the chances of having a positive trade. The second signal was also a deep dip buy signal. During the day, when we opened much, much lower here, we opened under the 30 RSI. But at the end of the day, we closed over the 30 RSI. So we had an intraday rejection of the 200-day moving average. We had an intraday rejection of the 30 RSI. Either one of those by themselves is legit, but both of them together much, much stronger. The third, if you can see this trend line, this red line here, this is a long-term trend line. During the day, or at the open, we broke way below the trend line, but we recovered and closed back above the trend line. Very important. So there are my three confluences of why I took the trade. You know, when we were up here a couple weeks before that, I was talking about the Qs possibly getting to the 200. Of course, I didn't really think they were going to get there, or that there was a low probability that they were going to get there. But I said, you know, if we get down there, I'll take a shot. So, you know, when I have this location here of this potential entry and it seems impossible to get there, it's not impossible, and it can get there, and you can see this clearly got there. All right, so when I entered here at 435.31, I have to decide, you know, how many shares am I going to buy? So I have a simple formula that I use that takes into account the volatility of the market. But first of all, you have to have your account value. So let's just use a $100,000 hypothetical $100,000 account. So if I have $100,000, I want to take 1% of that. 1% of 100,000 is, of course, 1,000. If you had a $50,000 trading account, it'd be 500. If you had a $25,000 trading account, it'd be 250. $1,000,000 trading account, be 1%, right? Or 1% would be $10,000. So $100,000, 1% of that is $1,000. I take the $1,000, I divide it by the value of the two ATR. This is basically two standard deviations of this move. So this is going to change every day. Right now it's 1664. It was different back here when I took it because it changes every day. But I take 1% of the account, divide it by the value of the two ATR, divide it by 1664. That tells me to buy 60 shares. Doesn't sound like a lot, but it's the proper amount of shares based upon the current market volatility and the account value based upon the way that I trade. Now, the first thing I do is that 2 ATR value that I just had, 1664, I take my entry and I minus 1664. Well, that's exactly my emergency stop. So if I have 60 shares and then it goes down 1664, how much have I lost? $1,000. That's my maximum allowed loss if I hit my emergency stop that I place exactly 2 ATRs below my entry. Now, the good news is that does not happen very often. It only happens about 5% of the time. The other 95% of the time, if I have a losing trade, it's going to be because my end of day stop or my end of bar stop was hit. So first thing, I placed my emergency stop 2 ATRs below, but again, only 5% of the time this can hit. My end of bar stop would simply be a close below the 200-day moving average. And 95% of the time, if I have a loss, it's going to be because of my end of bar stop, not my emergency stop. But you have to have the emergency stop in there just in case you have to have a, you know, everything's hitting the fan kind of moment. And if it does get there, well, you already know how much you lost of your account, right? 1%. Not fun, but recoverable. Now, I have this line up here, this horizontal line up here. Why do I have this? This is what is called my trailing stop level. It is exactly 1.5 ATRs above my entry. Remember, emergency stop is 2 ATRs below. My trailing stop level is 1.5 ATRs above. Now, if I get to that level, I don't do anything. It's just that now I am in trailing stop mode, which just means that now in the future, if I have a close below a previous bar's low, I'm going to get out of half of my position as a precaution, okay? And this happened, and I'll show you this in a second. So everything I've just talked about, the position sizing correctly, the emergency stop, the end of bar stop, the trailing stop level, these are all defensive moves. These are all, these moves, I'm doing these moves when something is basically going against me, okay, in a defensive way. But as like with any good sports team, you have to play defense, but you also have to play offense, right? You have to play offense and defense. So to play offense, what I do is I scale out of a portion of my position if it moves up in the direction I want it to move by a certain amount. And that amount is the value of the 0.45 ATR. Right now, the 0.45 ATR is $3.74. So let me show you exactly what I do. I change this every day. I take the closing price. So right now the closing price is $4.7534. And I'm going to add the value of the 0.45 ATR, which is $3.74 plus $3.74. That is my first profit target for Monday. So I put a limit order in at 479.08. And the question is, for how much? For 10% of whatever remaining shares that I have. If I have 500 shares left, 10% is 50, right? If I have 100 shares, 10% is 10. So I add the closing price plus the value of the 0.45 ATR. That gives me my first profit target. Now I take the first profit target, I add it again, the value of the 0.45 ATR. My second profit target, 482.82. I do it one more time, 482.82 plus 3.74, 486.56. So I'm going to have 3 limit orders in the system at those 3 levels that I just told you, and I showed you how to come up with those numbers for Monday. If it goes down, I'm not going to hit any. Maybe it hits 1, and if it hits 1, I take a little more off. So does that make sense? So anytime you see a big move up, I will be phasing out into those moves as long as it is at least it moves 3.74%. It's very important to me, and I really think it's a good, at least for me, it's a really good way to take a little bit off when the market gives me a little bit. Not everything, just a portion. Okay, so that is the offensive move. All right, so again, why did I enter the trade? Confluence of signals, intraday rejection of the 200-day moving average, intraday rejection of the 30 RSI, intraday rejection of the long-term trend line. Entered 435.31, placed my emergency stop 2 ATRs below. My end of bar stops have closed below the 200-day moving average. I placed my trailing stop level, and then we started off. We went up. I hit some profit targets, took a little off here, took a little bit more off. Here didn't take any. Here on the 13th, hit a profit target. Again, reducing my position size, locking in profits that the market can't take away from me. And by the way, here on the 12th, we got to trailing stop mode. And all this means now is that if I have a close below a previous bar's low, I'm going to get out of half the remaining position. Well, we just kept motoring up, motoring up, motoring up, motoring up, motoring up. Took some more profits here. And then here on the 22nd of August was the first day that it closed below a previous bar's low. I took off half of the remaining shares that I had left after what I entered plus scaling out of whatever I had left. I took off half there for a gain of 8.59%. Then we just basically went straight down. And boy, I was glad, 1, that I scaled out of that on the way up, and 2, that I took off half of the remaining shares here when I went into trailing stop mode. Well, now we've started to go back up. You can see we started coming down to the 200, and I thought, man, I actually may get stopped out on this trade on the remaining shares that I have. I think I told you last week, if we got down to the 200-day moving average, I was considering just getting back into a new full position of this trade. But we moved up, and so we moved up, took a little more profits here on this day, hit a couple profit targets. So again, as we're moving up, I'm scaling, scaling, scaling. Now we're at 55.87. If we start getting up into the 65 RSI level, then I will have another trailing stop rule that will get me out of the trade at higher levels. In addition to that, you see we have this long-term trend line that, look at this trend line. We broke the trend line, came up to it, failed. We came right up to it again, failed. If we continue this rally, we're still probably going to have to deal with that trend line. We could go right through it, who knows, but we may fail there as well. All right, but basically, if I get up into the 65 RSI level, then other rules come into play. And like I said, this is a deep dip buy, and I know it sounds like we have a lot of rules here, and I do. I've been trading for over 29 years now, everybody. I can't believe it. I've been trading for 29 years. I have rules for everything in trading. With all the different trading strategies that I use, I have rules, and every single one of them is there for a definitive reason. There is a reason for everything. And, I know here on this podcast, this may sound a little complicated and a lot of rules. And if it's new to you, yes, it probably will. But I do want to let you know that I do teach private one-on-one lessons in the evening time via Skype. I've taught people from all over the world, from all different skill levels, from absolute beginners all the way up to hedge fund managers, and I teach a 15-hour course where I teach all 7 of the different trading strategies that I use. I love to teach. I think I do a really good job of it. I've turned out some really good traders, and I will teach you step by step all the different rules and how to trade all these different strategies. And when you're done, you will be a better trader and you'll have a skill set that you can use the rest of your life. So if you're interested, my email is in the link of the YouTube video. Just send me an email and we can get a discussion started, but I know you'll be glad that you did it. Okay, so as is right now with the remaining shares that I have here on the Qs, the remaining shares up 8.46%. Okay, this one I took a long time on because I was kind of explaining some things. We'll go through a little faster here, but remaining shares on Qs up 8.46%. Okay, let's go to UNG. UNG is completely different type of trade. It's not a deep dip buy. It is what is called an abandoned baby. If you'd like to learn more about abandoned babies, go to my YouTube channel. I have a video there on abandoned babies and island reversals and why I really like to use these trades. Notice the green highlighted bar here. Why is it highlighted green? It is green because the previous day gapped down. For whatever reason, overnight, there was negative sentiment. However, the very next day, it gaps up. So we went from very negative to very bullish in a gap sense very quickly. That's why it's called an abandoned baby, because this one bar down here is kind of abandoned by itself. Now, what I have noticed, whether I'm going long or short, there's bearish abandoned babies as well. But if I'm going long or short and I see this happen with a gap down followed by a gap up, more times than not every single time, more times than not, when you look out into the future, you will be higher than when that abandoned baby, bullish abandoned baby took place. So this is a very simple trade. I entered here 1309 because we had a gap down, we had a gap up. I entered here 1309. I position size correctly, 1% of my capital, same thing that I just showed you on the Qs. I place a 2 ATR stop below, and I place a 4 ATR profit target above, which is proper trading from a risk to reward ratio. I'm risking 2 to make 4. That's called an asymmetrical trade. This is proper. My trades anyway, I want to have at least a 2-to-1 risk to reward ratio. So I'm risking 2 to make 4. In my experience with these type of trades, about 70% of the time I am going to hit my 4 ATR profit target. 30% of the time I am going to hit my 2 ATR stop loss. And you definitely hit the stop losses, but you definitely hit the profit targets. But like I said, in my experience, 70% of the time I make 4, 30% of the time I lose 2. It's pretty good, right? All right. So you can see it started off great. I thought, oh man, we're going to hit that 4 ATR profit, and then it came all the way back down. So anyway, this is a set it and forget it trade. Lose 2, make 4. The market's going to do what it's going to do. I have a stop order here at 1182. I have a in order to take profits at 15.58. But so far, we haven't hit the 2 ATR stop loss or the 4 ATR profit target, but still doing well. Currently, as is right now, up 9.46%. So pretty good trade on UNG with the bullish band and baby. All right, let's go to Tesla. All right, Tesla is a deep dip buy. Why? Well, very simple. Black line, 200-day moving average, came down, bounced at the 200-day moving average. I got in at 206 even, placed my emergency stop 2 ATRs below. My end of bar stops closed below the 200-day moving average. Placed my 1.5 ATR trailing stop level up here, 221.40. And then, of course, if it moves up, I'm going to take partial profits. Next day, did hit a partial profit. Next day, hit a partial profit. Next day, hit a partial profit. Next day, nothing. Next day, on the big day up, hit 2 partial profits, locking in those profits, reducing my position size. And then here on the 6th of September was our first close below a previous bar's low. I sold half of the remaining position for a gain of 3.21%. And then we've moved up, took more profit targets, moved up again. This particular trade with the remaining shares that I have, up 10.64%. So pretty good. VIX, all right. So VIX, interesting trade here, different type of strategy. You can see I have this green, with this big, huge move in VIX that made these charts hard to kind of look at. But you can see this green box that I have below here. This is called a bullish order block. What's an order block? An order block is your lowest low close before you change market structure to the upside. Okay, doesn't look bullish because it's all the way down here, but it is because this was the lowest point that people were willing to sell before we had a change to the upside. So the thinking is when it comes back down to it, it will probably find some support there, which it did. So when it was way up here and coming down, I said, look, if it gets down to this green box, I'm going to consider taking an entry, and I did. I got in at 44.70. I position size correctly, placed my emergency stop 2 ATRs below. My end of bar stop is simply a close below the low of the order block, 42.68. 42.68 is my end of bar stop. So I got long here, 44.70. As you can see, it started to take off nicely, took a little profits, came back, got into the bullish order block, and then that next week, I think it was up 22 or something percent. Now, of course, I took advantage of selling into this strength, right? Because I always take partial profits. On that particular day, the 3rd of September, we got to my trailing stop level, which just means that I'm going to take half off if I have a close below previous bar's low from now on. Then we moved down, then we had another big day up where I took some more profits, and then here on the 10th of September was the first close below a previous bar's low after reaching trailing stop level. I got out of half and locked in a gain of 12.69%. And then we have gone down since then, and the remaining shares that I have on VIX still pretty good, 8.28%. Google. All right, Google is a deep dip buy. I was mentioning last week that no one likes to buy anything. Everyone likes to buy everything on sale, except for stocks. Stocks, for some reason, they want to pay full retail. They want to buy when it's super high, and it makes sense because the media is talking about the markets, magazine articles, websites. Oh, it's going up, it's going up, it's going up. It gets people into that, FOMO kind of mindset. But as we were coming down last week, I said, look, I want to buy things on sale, including stocks. But it's scary because the herd's going the other way. I don't want to be running against the herd, but that's why I use technical analysis. I look for levels to help me create my trade and set up a structure for the trade. So if I'm wrong, I can be wrong quickly. If I'm right, I can have a nice outside gain. So this is Google. So look, I got long here Google on the 9th of September, right here, 148.58. Why? Did I just guess? I did not. This is a deep dip buy. Here's the 200-day moving average. Here's the 250-day moving average. Here's the 300-day moving average. On the day that I bought this, you can see, excuse me, apologize. On the day that I bought this, the orange line is the 300-day moving average. This is a key moving average. During the day, it went below it, yet closed back above it. It showed me that there were no more sellers underneath this 300-day moving average. So I got long 148.58. I position size correctly, placed my emergency stop 2 ATRs below. I placed my 1.5 I placed my trailing stop level 1.5 ATRs above my entry. My end of bar stop is simply a close below this orange line. It's pretty good. It's pretty close to it. If it closed 1 penny below, I simply would have gotten out of the trade. Remember, this is all based upon closing prices. So the next day, we moved up a little bit, but we held above the 300, so I stayed in the trade. The next day, we opened up higher, then we went below the 300. Does that mean I sell it? No. I wait for the closing price to make my decision, because the closing price is the most important part of the day. That's when large financial institutions, they have very smart people, they have the best information, they're dealing with a lot of money, they have a lot of technology. They come in, make their moves at the end of the day, and that's the smart money. So I want to base my trades upon what the smart money is doing, and the smart money told me, okay, it's closing above, so I kept it. So next day we moved up, took some profits, and then Friday moved up again, took some more profits. And I am in trailing stop mode, so that means now if I have a close below a previous bar's low, I'm going to get out of half of the trade. So this trade is doing very well. The remaining shares I have up 5.71% in 4 days. Again, being patient, waiting for a signal, okay? Pfizer, oof, I have a lot of trades. Okay. Pfizer, green box, what does that mean? It probably means that I'm looking at buying, right? Why did I buy? Well, this is what's called a fair value gap. Again, this is something I teach in my one-on-one course. But essentially, we had a low over here. We had another low, a lower low. Then this bar here on the 9th of September, this took out this swing high. This changed market structure to the upside. And if you change market structure to the upside, in my opinion, the correct move is to then buy dips. If you change market structure to the downside, then in my opinion, the correct trade is to short the rallies. But this is the opposite. We went from a bearish market structure to a bullish market structure by taking out this swing high, creating this fair value gap between the high of the 6th of November and the low of the 10th of November. So you see how we just moved up here and there was no overlap of price? That's what this green bar or this green box is. So yesterday, Thursday on the 12th, we came back down into the green box. We bounced off the bottom of the green box and up. I got long here 28.85 with a bullish fair value gap. Now, where's my, so I position size correctly. I placed my emergency stop 2 ATRs below. Where's my end of bar stop on this particular trade? It's a low of 28.29, which is just the low of this swing low here. It's the closest swing low. Well, this is a swing low now, but I bought it there. So 28.89. Here's my 1.5 ATR trailing stop level. If I get there, I go into trailing stop mode. But for 2-day trade, this one hasn't been too bad, and it's a good example of a bullish order block here, up 1.47%. And then last but not least, on the current open trades, I'm sure, let's see. Same thing, everybody. This is the same kind of trade as Pfizer. This is Intel. We have this bullish This one's a bullish order block because it's the lowest bar close before market structure change. I got into the trade, one, because we rejected the bottom of the bullish order block. We also created a V2 entry. Here's bar 1, here's bar 2, here's bar 3. 2 goes below bar 1's low, 3 closes above bar 1's close. I got in 1907, position size correctly, emergency stop 2 ATRs below, and my stop is simply the low of the order block here at 1880, where we are now at 1966. I know this sounds like a lot, and if you're new to this, you're going to like, I could never fall that in a million years, but you could. This trade doing very well, up 3.05%. Okay, those are my current daily open trades. Let's get to the close trades. Okay, this was McDonald's. I got short McDonald's here on the 6th of September. Why? We have a double top with a bearish MACD divergence. We also have a trend line that we came up and rejected the trend line. We also broke out of this previous high and failed. So I did get short here, 289.50. I placed my emergency stop 2 ATRs above because I'm short. I placed my trailing stop level 1.5 ATRs below. And my end of bar stop is simply a close over the bar that I entered in at 292.19. Okay, so got short the next day. Went against me. It went up, but it did not close above my stop. The next day, it gapped up huge. I was like, oh my gosh, what a horrible trade right off the bat. But then it reversed back down, stayed under the stop high, kept me in the trade. The next day, we started to go down. I did take a profit target, which is important because it was at profitable levels and it reduced my position size. But you can see the next day, it rallied back up, closed above my stop. So this was a losing trade, but it was a small losing trade, and I lost 0.89% on the trade. That's fine. That's nothing, right? That's nothing. And then, more importantly, really glad that I got out because on Friday it moved up 1.43%. So this was a losing trade of 0.89%. And last but not least, another trade, this one losing trade as well. We talked about abandoned babies. This is an abandoned baby to the downside. We gap up, everything's great. We gap down. As we came back up to the bottom of the baby, I got short here, 63.23. Now remember on these, this is a short, remember on these, 2 ATR stop, 4 ATR profit target. Well, this one was a losing trade, and it did get to my stop, even a little bit worse because it gapped over. So on this trade, I lost 2.24%. But like I said, about 30% of the time that's going to happen. But 70% of the time, in my experience, I'm going to make double what I lost. But this one was a losing one. So real quick recap on the daily trades. Current remaining shares on the Qs up 8.46. UNG long trade up 9.46. Tesla up 10.64. VIX up 8.28, Google up 5.71, Pfizer up 1.47, Intel up 3.05, and then the two trades that I closed out, McDonald's down 0.89, Budweiser down 0.24. So, usually with my trades, that's what you'll see. You will see my losing trades, I'm in and out very quickly, usually for a pretty small loss. And the winning trades, I'm in those for a while. And usually a lot more the gains than a loss. So that was a good example. Okay, real quick now on the weeklies. Again, weekly bars close on Friday. So I am going to make my decisions on Friday. This is Apple. You can see the red box up here. If it's a red box, I'm probably shorting in that area. This is a bearish order block where I got short here at 228.80. This is the high and the low. The order block is the high and the low. This was the highest bar close before we had a market structure change. So when we get back to that order block, that's probably where it's going to find some resistance. It's exactly what it did. So I got short 228.80. I placed my emergency stop 2 ATRs above. My end of bar stop is just simply a close above that order block there at 232.81. And so got short 288.80. My 1.5 is down here, going to trailing stop mode. The next week went down. I took some profits at profitable levels. And then this week didn't do too much. So this one still doing well. And so far, this particular trade, short trade on Apple, up 2.9%. And then last but not least on the weeklies is Disney. I did take Disney on the weekly trade with a deep dip buy. This is a weekly bar. You can see during the week we went under the 30 RSI, closed back above the 30 RSI. I got long here, 85.90. My end of bar stops a close below 82.95. My 1.5 ATR trailing stop level is up here at 93.20. Have not reached it yet, but this particular trade on the weekly doing pretty well, up 5.29%. Okay, those are all my trades, and I feel like I've been talking an hour already. I usually don't have this many trades, but today I do. But anyway, I hope that was helpful. And let's start and talk a little bit about trader psychology now. Okay, a little bit about trader psychology. This is from my good friend Steve Burns, great author, great trader, great coach. I've worked with him for years. He has great books. Just check him out on Amazon, and you can follow him at @SJosephBurns over on Twitter as well. Let's see what Steve has to say here. Well, this is a Japanese saying. So, cutting losses explained. If you get on the wrong train, you should get off at the next station as soon as you realize it. The longer you stay on, the more expensive the return trip may be. It's true, right? You get in a trade and you don't get off at the next station, and then you don't get off at the next station, and then you don't get off at the next station. Your return back is going to cost you more. It's the same with trading. Look, just take your first loss. When your plan tells you to get out of something, there's going to be 10 different reasons in your head why I should probably stay in because next week is this, and I think it's low enough, and da-da-da-da-da. And you know what? 80% of the time, 85% of the time, excuse me, you are going to be right. It probably will come back a little bit, but there's that 15% of the time where it will go down, and it will go down, and it will keep going down, and every day you're going to say to yourself, well, it can't go any lower than this. I mean, my God, I can't sell it here. And then it does, and then it does, and then it does. Take my advice, everyone. I've been trading over 29 years. The first loss is the easiest loss. Get your ass out of the trade when you're supposed to. You can get back in. You can always get back in. And you're going to feel better about yourself if you adhere to your rules. It is so important to adhere to your rules. Look, if you create a trade and it's a valid trade and it goes against you and take a loss, it doesn't make you a good trader. It's the opposite. It makes you a good trader by following your process. That's what makes somebody a good trader, is that they follow their process, not whether or not that particular trade was profitable or not. Really try to get that into your soul, what I just said. You become a good trader by following your rules, following your process. You know, if you need help with the process, you need help with rules, let me know. Like I said, I teach private one-on-one 15-hour course. I will do that for you. But whether it's from me or from somebody else, you have got to get yourself a process. Listen, I haven't mentioned it yet on the podcast, but I'm creating a new service that I think is going to be immensely helpful for people. I'm very excited about it. I've talked to some very famous traders about this, and they're like, oh my gosh, I can't believe no one's done that before. And I said, right? But, you know, it has to do with this kind of stuff. So when the time comes, I will let you know about that. I'm very, very excited about it because I know it's going to be a good business for me, but what I really know is that it is going to be very, very helpful for people. All right. So yes, If you get on the wrong train, you should get off at the next station as soon as you realize that the longer you stay on, the more expensive the return trip may be. If you don't get out at your stop and it goes down and down and down, it's going to be more and more expensive. Get out of that trade that's not working. Take that money, put it into another risk to reward ratio that has a chance of working. If it's just going down and down and down, there's a reason for it, and that money would probably be better allocated in a different trade. So thank you very much, Steve Burns. I hope this was helpful. Get yourself a process, follow the process. I don't care what it takes. That's what makes you. Write it down, put it on your computer. Following the rules makes me a good trader. That's what makes you a good trader, and that's what will get you the money in the long run. I always get fired up when we talk about this kind of stuff because I deal with it all the time. I deal with students, I deal with traders all the time. Like, did you follow your process? No, because this and that, blah blah blah. I'm like, yeah, blah blah blah. Just get out of the trade. Get out of the trade. Wait for you until you have another valid trade. Anyway, sorry, I'm going off on a soapbox because I dealt with that a lot last week. All right, let's take a look at the potential, the trades that I'm looking at for next week. Again, I have 7 of them here. Now, theoretically, next Monday, Monday, when the market opens up, all 7 of these could trigger at the same time. Does that mean I'm going to take all 7 trades? Absolutely not. I have a rule. I only take 1 trade per day. I don't care if I have 7 legitimate entries. I'm going to narrow it down to 1 trade. How do I narrow it down? Which I give it a score. It's like a quality score. It's like a report card. How many signals did it have? How many confluences did it have? What does it look like on multiple time frames? What is the risk to reward ratio? How weak or how strong was that stock relative to the rest of the market? That's another thing, that gives points or takes away points. And so I always narrow it down to the one that has the highest quality score. I'm going to pick the best candidate with the best marks, right? And again, this is what I teach in my one-on-one. This is what I teach my students, how to differentiate. If you have 5, how to differentiate it down to the best one. The devil's in the details, everyone. So just want to point that out. Let's start with Amazon. Okay, Amazon, that's Disney. Amazon, all right. So you see red boxes. So I'm most likely looking for a short. Now, currently we are in a bearish order block. See how the price is within this block here? I didn't take the trade. It's a legitimate trade as is right now. But what I'm really looking for ideally on this trade is this higher red box. This is your highest high before market structure change. If you come back into this order block here, this would be a very good risk to reward ratio and a very easy stop because just a close basically making new highs here. In addition to that, you see this trend line we have here. This is a long-term trend line that is above the price, which means that this is acting as resistance. Now, do you see how the trend line in the future, in the next few days, dovetails exactly with the bottom of that bearish order block? Right about here? That would be a sweet place to get short. It's not there yet, is it? It's not even close to getting there. But if it does get there, I will consider getting short getting short Amazon. Look, we could go right down from here. We are in a kind of a mid-level order block right here. I didn't take the short, but it would have been legitimate. It may just go down like, dang, I wish I would have taken that one. But this one really is the top-notch area for the short because it's the bottom of the order block and it also dovetails with the long-term trend line, which is above price now, which acts as resistance. So 96, it's $10 above. It's $10 above where we are, but that's again my point of being patient. This is perfect. It's perfect for a short. It doesn't matter if, it doesn't mean it's going to work out, but technically it is perfect. Remember how I'm waiting for that perfect pitch? Right here is the ball across the plate, but I don't know if it's going to get there. If it gets there, I'll consider taking the trade. If not, I'm just not going to mess with it. So about, sorry. Yeah, 195.83, 196. That is where I'll be looking to short, and that would make a lot of sense for me to short there. Boeing. All right, well, Boeing looks horrible. No one's interested in Boeing. There's bad news all the time, blah, blah, blah. But the technicals are telling me a little something. Look at this low here. Look how deep these red MACD bars are. MACD bars are momentum indicators. The lower they go, the more selling momentum. So we have very deep bars here. Now, over here now, we are lower than we were back over there. Wouldn't you agree? But you see how the deep red MACD bars, they're down, but they're not as deep as the first. So the price is lower here than it was here, but the MACD bars are not as deep here as they are here. What does that mean? That means that from a MACD momentum standpoint, you are the Boeing is starting to run out of selling momentum, or in other words, they are starting to run out of sellers. And the implication is if you run out of sellers that you are going to go up. So big picture, I like this double bottom bullish divergence. However, I still need an entry signal. Most likely the entry signal for this would be a deep dip buy with an under 30 over 30. Right now we're at 37.16. So I would need the price to go under 30 and back over 30 to give me a signal and give me a structure for the trade. So we'll see. It may not get there and I may not get the trade. You can see, look all the way over here. Under 30 over 30. Was that a good entry point? Yeah. And a double bottom bullish divergence as well. But I like this here. Boeing, of course, has a lot of bad news. For me, I like that. I know that it's going on sale, but I still need a legitimate signal. So really, next week, about all I'm looking for on Boeing is under 30 over 30. However, if we got a bullish abandoned baby or a bullish island reversal, I could also take that as well. And if you want to learn more about babies and islands, just go to my YouTube channel. All right, let's go to Caterpillar. Look for my previous podcast that I had marked the green levels of where I would be interested in buying. Yeah, pretty good. Last week, it almost got there. It didn't get there. I didn't take the trade, but pretty good. But now I'm looking at a short. Why a short? Well, you see the red box up here. Why a short? Okay, this is your highest up bar close before market structure change. That's what makes it the bearish order block. In addition, look at this long-term trend line here. The high from here over to the 29th, that downward sloping trend line. Well, if we get into the red area, if we get into the order block area, just that by itself is a legitimate short for me. But we also have the trend line above adding additional resistance. So next week, this one's going to be tricky. If we reject the bottom of the order block, I could go along there. Ideally, what I'd like to see it get a little higher into the order block, reject the trend line. So rejecting that trend line, that's significant. If it has a reaction at the trend line, that's significant, especially because on top of it, we are in the bearish order block. So somewhere here, 352-ish, 351-ish, depending, if and when it gets in there, that's about what I'd be looking for. So 5 or 6 points to the upside on Caterpillar is what I'd be looking for a short, but I'm just going to have to make a game day decision on the day. And see what the price action is. But that's the area. Basically somewhere between 350 and 356 is the potential shortable area for me. Meta. Okay, same thing. You can see the red box. What's the red box? Well, it's the order block. Here's the highest up bar close before market structure change. Somewhere here between 527 and 540. That's a lot of range. I've highlighted this red bar here. This red bar is halfway at this big down bar here on the 23rd, and it also dovetails with the 1 ATR channel. So, for the purposes of this channel, ideally what I'm looking for is kind of a rejection of 532. That would be my potential shortable area. My stop would just be a close above this order block here, 539.77. Altria, MO. Wow. This thing just went up and 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 up. I talked on the podcast about about Altria. You can see we connect this high here, we draw it out in time. I said if it gets near that channel, that's probably where I'll look to short. Look how close it got, and then it came right on down. So I didn't get that trade, but it was the right thinking. But the important part now is that we have an order block. Look, here is your highest up bar close before market structure change. We have an order block between 53.79 and 54.38. Not a lot of range there, but you know, we broke down, we lost this trend line as well, but we are in the value zone now. This kind of makes sense. So I would imagine some buyers would come in, but if you break structure to the downside, then I am looking for to short the next rally. Well, look, here is this trend line that is still above us as resistance. We have this bearish order block. Depending on how many days, if we rally, I don't know if we're going to rally, we could head straight down. But if we rally it, depending on how many days, we may get right to that trend line and right to the bottom of that order block at the same time. And that would be a potential short area for me. And the stop would be very close. It would just be a close above this swing high here. So essentially what I'm looking for is a short somewhere between 53.79 and 54.32. That is the area where, for me looking for a short, that is the area. If it's going to fail, it will probably fail out. But it may not. It may just go ripping higher, right? That's why we have to have our stops. SPY. Okay, well, we're knocking on the levels of all-time highs here. Let's take the all-time high with the previous high, connect that trend line to the downside. This is a downward sloping trend line that we have yet to test. In addition to that, we have a bearish order block. Highest up bar close, again, before market structure break to the downside. So Monday, Tuesday, look, if we reject that trend line inside that order block, that would be a legitimate short entry spot for me with a good risk to reward ratio, because if it just closes above the high of that order block, which is 564.20, I would just get out. So you can see I'm kind of skewing here to the downside. Not my opinion, it's just that's what the charts are telling me. There's more short opportunities here, but they haven't done. It's not like I'm just loading up and going short for no reason, and I'm not going short. I have to wait for these things to trigger, as I've been explaining. And then last but not least, ExxonMobil. All right, well, I do have a long potential long here. So Exxon's on sale here. Look, we're at the 200-day moving. We're getting close to the 200-day moving average, but really, I'll just have to see what happens. But we have the 200-day moving average here. We have the 250-day moving average here. We have the 300-day moving average here. You know, any of those three would be a legitimate deep dip buy. Ideally, I'd rather take the 300 than the 200, but market doesn't care what I want. It might just bounce at the 200 and go straight back up. I don't know. So I'm kind of leaving this open-ended here for a potential rejection of the 200 or the 250 or the 300. All these are major moving averages, and they're all legitimate. Of course, the lower that I could get it, the lower the RSI would be. And remember, an under 30 over 30 at the same time it rejects a major moving average. That's a nice setup. So I'll just have to play this one by ear, but I am looking to potentially try to buy Exxon here on this weakness. But it has to show me that it's going to reject one of these major moving averages. So those are the dailies. Let's head over to the weeklies. I only have a couple of them. Be really quick here. And here's AMD on the weekly. Well, you see a red box above. That probably means I'm looking for a short. This was the high back here on this 12th of July. This was the highest up bar close before market structure change to the downside. So I'm looking to sell a rip. I'm looking to sell a rally. Look, we're quite a long ways away from this. I mean, the bottom of the order block's 170, basically 173 up to 187. That's a long ways away. But look at the trend line here. This trend line is above us, acting as resistance, and you see how the trend line is running right into the bearish order block. Happens a lot. I love when I have resistant trend lines above that run into the order blocks. It gives a better high probability that if it gets into this location, it's going to head back down. So we'll see. It's really not even close, but if it does get to the bottom of that order block or rejects that trend line, I would consider potentially getting short on the daily. And then last but not least is USO, which is oil. And of course, energy's been very, very weak. I've highlighted a green bar down here. What does that mean? Well, that means that's kind of the area that I'm looking to get long. Why? Well, 200-day move or 200-week moving average is down here. That is important. And then we also have the negative third ATR channel that's kind of dovetailing with the 200-week moving average. 92% of prices when they get to the negative third ATR channel tend to stop going down. Well, the confluence of the negative third ATR channel and the 200-day in that same vicinity is good. And look, we're at a 39.91 RSI. So if we head lower, we could potentially go under 30 RSI, over 30 RSI, under the 200-week moving average, over the 200-week moving average. That would be a good entry. That would be a good entry with a good risk reward. It doesn't mean it's going to be a positive trade, but it skews the odds in my favor and gives me a structure to base it off of. Over 200, I'm in, I'm bullish. Close under 200, I'm out, I'm bearish. All right, so there we go. So I talked a little bit about what the market tends to do when the first rate cut starts, and I wanted to go over that. I hope it's going to be helpful. Again, if it is, if you could hit the thumbs up button, man, I would really appreciate it. This is Dr. Chris Martenson. I watch some of his stuff on YouTube. Really good, really smart guy. Talks about a lot of different things. But you know, there's an old saying that traders love rate cuts, but the market hates rate cuts. And you have to think to yourself, why is the Fed considering cutting rates? Is it because inflation's coming down? Okay, yep, inflation's coming down. But generally, over time, if you have a rate increase, a sharp rate increases like we have, and then you have a pause in interest rates, and then you have the first rate cut, everyone's psyched about it. We're going to get a rate cut. Woo, 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 right? Why are they? Because they think, oh man, well, the market's going to rocket up from here because we got a rate cut. And usually, initially, it does. But if you look at the facts over time, you look out into the future, the market is down a lot more than it's ever up. And I want to show you this. So the sentiment from bulls is that rate cuts are suitable for the market. This is true in the long run. History shows that the market pumps or goes up on average for 25 days after the rate cut happens, followed by an average of a 13-month sell-off. So look, here are the four different cutting, similar situations as what we're into now, where we've had rate increases, pauses, and then cuts. Every time we've had the rate cuts, the first rate cut, do you see how initially we've taken off, even up to the point of going up 7%? But out of all four times that we've had these rate cuts, look what's happened into the future. They have all gone down. So please keep that in mind. I'm not giving you an opinion or telling you this is going to happen. It could be totally different this time. But if you just look at the history of the market, what it's done after rate cuts, this is pretty clear. We have rallied initially on the euphoria of the rate cut, but go out into time after that, it's been lower all four times here in this situation. Kind of like with abandoned babies and whatever, you know. You look out in the future, they usually are higher or lower from when those abandoned babies happen. So please keep this in mind, right? You know, the reason the Fed is going to be cutting rates is economic things are slowing down. That's what people get confused. They think, oh, it's only because of inflation. Things are slowing down. Those rate cuts, those lag effects from all those rate increases are going to start coming into more and more and more of the economy. So please be careful and remember this history. I'm not giving you any advice. I'm just sharing with you here what the facts have said happens over the long run after the first rate cut. All right. So I hope today was helpful, everyone. If I can help you with your trading, like I said, I do teach private one-on-one lessons, 15-hour course, 5 sessions. Each session is 3 hours. I'd love to have you as a student. The price of the tuition for the course is $1,750, worth every penny. You're going to learn really good things. You're going to study with me one-on-one, and I think it's the best way to learn anything is to study one-on-one with your instructor. I have an alternative to the one-on-one course, the live one-on-one course. I have a really good video course on udemy.com where I teach you the deep dip buy approach. It's 9.5 hours of video. It's very affordable. It's somewhere between $30 and $50, but it's 9.5 hours. And I teach you step by step. That's a great and affordable way to get started. So if you're interested in that, the link's in the description. If you're interested in the one-on-one course with me, my email is in the link of the description as well. If you like today's podcast, I'd really appreciate if you could hit the thumbs up button. It really does help out the channel. And hey, if you haven't subscribed, please subscribe as well. And then I always like to leave you off. Please try to go out and do something nice for another human being today. If we all did one nice thing for another human being, it really would make the world a better place. If you could also find it in your heart to go out and try to do something nice for an animal as well, I would really appreciate that. The animal would appreciate it. They appreciate acts of kindness just like we appreciate acts of kindness. So, it's not a bad thing, right? One nice thing for a human, one nice thing for an animal. There could be worse things, and it really would make the world a better place. So I appreciate you being here, everyone. God willing, I will see you next week. If you have any comments or questions, please leave them in the comment section. I'll do my best to get back. But thanks again, everyone. Hope you enjoy the rest of your week. Take care. Bye-bye.
U.S. government required disclaimer. Stock, options, futures, and forex trading is not appropriate for everyone. While there is a potential for large rewards, there is also a substantial risk of loss associated with trading. The material in this video or live broadcast is not geared towards any particular individual or to any particular financial situation and is not intended to meet the particular investment objectives of any viewer. This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Any and all information contained in, implied, or referenced by this video or live broadcast is not to be construed as investment advice, and no representation is made that any individual or entity involved in production of this video or live broadcast is an investment or financial advisor or is registered or authorized to give any financial advice. We are publishers and educators only. Therefore, the various producers of this video or live broadcast will not accept liability for any loss or damage of any kind which may arise either directly or indirectly out of the use of any of this material, including any loss of profit. No representation is made that any account or investment will or is likely to achieve the profit or losses demonstrated. We recommend consultation with a licensed and qualified professional before making any investment decision. This video or live broadcast is not to be construed as an offer to buy or sell any security, financial instrument, or financial product of any kind. Notice is hereby given that any individual or entity involved in production of this video or live broadcast or their clients may have an interest in any security, financial instrument, or financial product mentioned or referenced. Any simulated or hypothetical performance result depicted does not represent actual trading and therefore may under or overcompensate for the impact of various market factors such as lack of liquidity. Thank you.